Today, we'll put the spotlight on exchange-traded funds or ETFs in this episode for our viewers. The flows in this category for the assets under management stand at 4.89 lakh crore rupees. But this is a category which is a little difficult, or sometimes it needs extra expert advice to understand as well. How does it differ from regular mutual funds? What are some of the costs or the other aspects that you should be aware of as well? Let's get in Feroze Azeez, Deputy Chief Executive Officer at Anand Rathi Wealth, to decode that for us, because there are a lot of nitty-gritties in this particular asset class as well. Feroze, good afternoon. Thank you so much for joining us. And we've had some conversation about it off air as well. But let's start with the basics first up and try and understand how is the ETF index constructed? What is the identification of constituents here?
Yes, Sonal, like you rightly pointed out, ETFs and index funds could be complex as well. They seem very simple, but there is some degree of complexity. First, an index fund is let me just describe for the viewers' benefit. An index fund is a fund which aspires to mirror an index. An index is nothing but a platter of stocks or a combinations of stocks which have come together to form an index. So a fund which tries to mirror that performance is called an index fund. Now, what's an exchange traded fund? Exchange traded funds of an index is nothing but a fund which is going to mirror the index, but you can buy and sell on the exchange, not with the asset management company. That's called an exchange traded fund. Exchange traded funds and index funds, from an objective standpoint, try and achieve the same objective, to mirror a passive index. So in this, the great part is, from an optical standpoint, there's no fund manager, there's no human discretion. In turn, there is a lower cost. So these two ETFs and index funds are getting popular in India as well. Globally, they're very popular. In India, if you look at it, close to about 6 lakh crores is there in these two asset classes or product lines, as we would rightly want to call them.
Okay, very interesting. So that is the difference between, say, a mutual fund and ETFs. And we also will discuss why is it not so popular in India. Of course, it is heating up. But other than that, the other aspects as well. But tell us, Feroze, does investing in the benchmark make sense then? How do you look at investment in this particular category?
You see, I personally, after having done a lot of study of how US capital markets behave, how Indian capital markets behave, for all our clients, I have never bought myself or my clients an index fund. Of course, it's quite a counterintuitive thing, because that seems to be the trend today, because it's low cost. Now, if you look at how the ETF industry is growing, let's throw some light on which are the most popular indices which people love to invest in. So 92% of this 4,89,000 crores, which is the ETF assets under management, is in two indices, rightly so, which is Nifty and Sensex, because these are the most popular and prominent indices available in India. The third largest index, which is popular in the ETF market, is the bank ETF. So that takes about 6%. So if you look at these three indices put together, is close to about 98% of the total ETF AUM. The reason why I'm actually throwing some color on the industry is for a viewer to see which are the popular indices which a person is, or the other herd is ending up buying. Now, coming to the point, Sonal, do these make sense? To my mind, if I have to give you an Indian context, India is a reasonably new market. We were doing a study, because Warren Buffett propagates index funds and passive funds. So we have to take that suggestion seriously, because he's one of the world's greatest investors. And he actually says that just buy index funds or ETFs. So we as a wealth management outfit can't discount such a credible source of information. So we did a study to find out the age difference between the US capital markets and Indian capital markets. We realized that there is a 60-year difference mathematically as per our computations. That means India is still a reasonably immature market. That's why there is a possibility to beat an index very easily in India. So we think that index funds and ETFs, there's a long way to go in India, another 5-10 years. Active fund management can create value, mathematically establishable. But like you said, Sonal, quite a few people buy index funds, but they don't understand how indices are being formed. How is the mid cap 150? Which are those 150 stocks which NSE is choosing for you? How is that formed is something which I think a lot of our viewers should know before
So,
they invest in these
so
index
let
funds.
me get a follow-up on that itself. You spoke about the other indices. Let's talk about NSE 500 itself, right? Because it says it is the 500 top companies in that particular index, but there are some which are not the constituents of that particular index. What explains that?
Yes, Sonal, this is a brilliant question. And like you rightly said, NSE 500. Why is this very important an index? You may never invest in an NSE 500 ETFs, but if you have bought a mutual fund in India, this becomes a very important index for you. This NSE 500, which is as per NSE's website, I quote, it is the top 500 companies as per total market cap from an eligible universe. That's what NSE's website today reads. But these 500 companies are then further broken down into three subgroups. The top 100 are called NSE large cap, which is what large cap fund managers are expected to beat. That's their benchmark. The subsequent 150 is called the mid cap, and the last 250 is called the small cap. And every fund manager has been given this as their tier one benchmark if they are in the large, mid, and small cap. Now comes to Sonal, your pointed question. I was very surprised to see close to 30 companies which were greater than 10,000 crores in market cap, and they were not a part of NSE 500. Whereas NSE 500's smallest constituent today is 4,800 crores. So I was very surprised. If the smallest constituent is 4,800 crores, that automatically implies the 10,000 crore company should have made the cut. But there are close to about 25, 30 even today who are not a part of 10,000, are not a part of NSE 500 because there are two tricky, very tricky rules in NSE 500. Those are very tricky. I'm calling them tricky because because of those two rules, several companies which are greater than the smallest constituents have been kept out for long periods of time. What are those rules? If you have to be in NSE 500, you have to not just beat the 500th company, you have to beat the 350th company. Let me read the rule as per NSE. A company must be among the top 350 in terms of total market cap to be included in NSE 500. It of course perplexed me because I always believed to get into 500, you have to be 499th. But this rule says that you have to be better than 350th to be a part of 500. The second tricky rule, again I read verbatim, a company if falls to the rank below 800 in terms of total market cap would be excluded from the index. That means to enter 500, you have to be better than 350. And to be thrown out of 500, you have to be worse off than 800. And the 350th company is a 15,000 crore market cap, give or take. And the 800th company is a 1,000 crore market cap. Unless a company falls from 15,000 crore market cap to as little as 1,000 crore market cap, give or take, it will not be excluded. So these two rules are the tricky ones. That's why, Sonal, your question is very valid. There are so many large companies, larger than the 500, which are part of it, but they still remain outside. And several such companies. MSCI, which is the Morgan Stanley emerging, which is an index provider globally, has about 460 stocks in a small cap portfolio. But an Indian fund manager only has 250 stocks in the small cap portfolio. There's a lot desired in the way we construct our indices in India. There's a lot of learning hidden from the global side, like MSCI has 460 odd stocks in small cap. And the domestic guys who sit in India have only 250 stocks in the small cap. NSE 500 covers only 91.8% of the market cap. But MSCI's large, mid, and small covers 99% of India's market cap. So an index fund manager index fund investor should do a lot more study and not just blindly follow an ETF strategy without understanding how the portfolios are created.
I think we'll have to have another complete different long episode on that discussion as well, right? Because this has brought about a lot more questions on index funds, the construction and other aspects as well. But thank you so much for shedding light on how this particular index, at least NSE 500, is constructed. And you're right, it's quite tricky. But let's continue with our discussion on ETFs after understanding this one. There was a big inflow in India ETF one day before election results, Feroze. Is there an expectation of flows tapering off now? What did you make of those incoming flows?
Sonal, if you break down the ownership of ETF, okay, people may outside the industry not know, the largest owner of ETFs is the EPFO, Employee Provident Fund organization, right? So our monies which go as a deduction in the EPFO get an allocation of equity. So ETF owners, so any large flows, you can attribute it to institutional participation because EPFO, if I know that number correctly, pardon me if it is marginally incorrect, 15% allocation is what they had decided to put into equity. And that's why a reasonable portion of this 4,89,000 crores is owned by the EPFO. And that's why you see Nifty and Sensex queuing that number. So I would not read too much to answer your pointed question with that inflow. That would just be an allocation which would have come from some institutions.
Okay, all right. And we anyway saw so much exuberance just one day before the election results. So this was just a part of that. Feroze, suppose one investor is looking at investing in ETFs. What are some of the factors to be kept in mind? And how would it differ from mutual funds?
Yes, one factor to keep in mind is that you should not have a fair expectation from an ETF because there are expenses. So there will always be a negative return relative to the index. Like last year, 2024, the benchmark was underperformed by the ETF industry. Alpha was minus 0.74 because there's going to be expense. There's going to be very difficult for you to buy a 250 stocks if you are looking at a NSE small cap 250 index funds. So you should have a fair expectation from the institution that you will underperform the index by 0.5%. Quite a few index fund investors say, why is there an underperformance of 0.5%? So you're sure to underperform marginally. That's also called because of the tracking error, because it's very difficult to mirror an index exactly precisely. And secondly, there's also going to be some expenses. That's one thing you have to keep in mind. Second, when you're buying index funds, if you really are wanting to buy index and ETF, stick to large cap category because there's so much alpha possibility in the active management. Like, for example, Anand Rathi ran a model portfolio for the last 11 years and we've beaten Nifty by 182%, right? But in the large cap category, beating Nifty is so difficult. So if you're really keen to buy an ETF, have active management for small and mid cap and other categories. For large cap, you may not want to buy a large cap fund for 10-20% of your portfolio. You can surely buy a Nifty index fund because there the cost is lower and the chance that a large cap fund manager beats an index is lower. Of course, there is a Sandeep Tandon kind of quant which has beaten Nifty by 28% in the large cap category last year. But if you want to buy an ETF, best ETF to start with is the large cap category. So these are the two small suggestions I would want to make to the viewer, Sonal. And I would like to keep my answers brief. Sorry, I've gone a lot of the previous segment.
No, those are perfect answers, and that is helping our viewers for sure. But Feroze, you spoke about some returns. You spoke about what an investor should look at when they are investing in ETFs. But what are some of the other fundamental differences between mutual funds and ETFs? You spoke about transaction costs. The management style, does that change as well? Are there the price variations that you would like to talk about?
You see, when you buy a index ETF or sell an ETF, for a Nifty ETF, you lose 36 points as transaction cost in an ETF on buying and selling on the exchange because the STT is larger. In an index fund, for example, the cost is only 3 rupees to buy and sell. All else equal, per Nifty, you spend 3 rupees in an index fund, you spend approximately 36-40 rupees in an ETF. This, I have done numerical computations from a treasury standpoint. This is very, very important. But for an investor, it's not too much of a difference. But ETFs have a larger STT than an index fund. That's one thing which is a fine print. You may never get to know unless you read those big fat books of Kim. But that's one thing. Which is very critical. And active managed funds, I think, are also popular. There are 150 odd fund managers in India which can beat. But I think ETF is an instrument which you buy and sell on the exchange. So you can have different NAVs during the full day. In a mutual fund, you will, or an active or an index fund, you will have only one price per day. But in an ETF, if you bought it in the morning, the price could be different. And if the market fell and then you bought it later, the price could be different. For example, let's go 2 days behind, which is 4th June. The Nifty opened at 23,000, close to 23,000, went to 21,250, and then closed at somewhere around 21,900. In this whole day, an ETF buyer could have had one ETF buyer could have bought it almost 5% more expensive than another ETF buyer. But a mutual fund investor, all of them buying the same mutual fund would have got the same price. This is one of the most important differential. If you're a savvy investor, an ETF can give you different prices during the day, and you could probably time your investment better depending on your requirement.
And a lot of mutual fund investors would have thought, I wish my SIP deduction date was just today, on the 4th of June at least, to get that better NAV as well. But Feroze, in ETFs, price discovery has been a problem. Do you think that, be it equity, debt, or gold ETFs, as they're not as liquid and not as popular in the country, how can an investor navigate that issue?
So for an investor and a viewer, I don't think it's too much of a difficulty because there's also a liquidity manager which is there. Now, let's assume in the treasury, if we bought 500 crores of ETFs and I want to liquidate it, then it is a difficulty, absolutely larger amounts. Market making is still a practice, which is a reasonable responsibility of the asset management company. For 25 crore plus tickets, you can straight place an order with the AMC itself. So I personally think that for a retail investor, price discovery or at least market making can definitely be better. Sonal, your point is very valid, but the price is not going to be too different. But yeah, I think there's a lot desired in terms of efficient market making for lower bid-offer spreads in ETFs in India.
Yeah, I think we need a lot more discussion and a lot more awareness as well about this product, right? We spoke about certain misconception that people had already when it comes to index formation and ETFs. But let's talk about the other asset class within ETFs. Should people invest in gold through the mutual fund or the ETF route? And for those who want to pure play invest in gold, should they choose a gold ETF or a gold fund?
I would say gold ETF is better for a person who has lump sum money. For a person who wants to do a systematic investment plan, ETF is not an alternative at all. So gold funds is nothing but a group of ETFs packed into one. So gold fund and a gold ETF will largely depend on the viewer or the investor's status of his capital. If he wants to do a recurring investment, he's left with gold fund as a choice. If he has a lump sum 1 lakh to allocate, he can definitely choose an ETF.
Okay, all right, makes sense. We spoke in detail about ETFs, spoke in detail about index funds as well, but it boils down to one thing. Because we saw so much volatility, a lot of investors would have seen such a crash for the first time. Somebody who entered the market after 2020, the Gen Z investors as well, right? What should an investor do with the SIPs when markets have fallen so much or there's so much volatility? Do they change the amount they're investing or they change the timing, like, change dates? Some people actually think investing on a certain date would also help.
Yes. So, Sonal, I think there are two kinds of individual investors. One who have chosen the mutual fund route, the one who have chosen the stock route. If somebody has taken a stock route, of course, the number of demat accounts is a reasonable proxy to say a lot of Gen Zs want to participate in stocks directly. They have seen one of the largest jolts of volatility. And because they've not seen even one election, now from 99, I've probably 2004, I've seen general elections. So this is very normal volatility for a general election, right? I was always telling that the India VIX is so low, it is ridiculously low, and I predicted that it will touch 30 on the election day. It did touch 31, because if you look at election days, those are. So point one, if you are an investor, if you're in a mutual fund, ride this volatility. This volatility is a great volatility to have. Right, India has thrown up lower volatility than even the US S&P 500, and these one or two jolts will help you calibrate your expectation from equity market. Point one. Point two, to a new investor, I would definitely want to remind him that every year, once or twice, market always shows 10% fall. In the last 21, 22 years, market has shown 50 times a 10% correction from peak to trough. If that's the nature of the beast, is why you get twice more than the FD return or thrice more than the FD return. So live with the volatility. That's the reason why you deserve 2 times more than an FD return or 3 times more. Don't hate it. If markets become lower volatility, the returns will also become lower, right? So that's point two. Point three, if you're a stock investor, this is a great wake-up call. Because if Nifty can, in this term of the new government, deliver 11, 12%, good funds can deliver 14, 15, 16%, which is good return. So I think I would definitely tell the other group, which is thinking that I can do stocks myself with change in price 10%. On the election day, I saw the biggest names with 1 lakh crore market cap with minus 15, minus 18%. But I didn't see a mutual fund fall more than 5, 7, 6%. So I would say, please move from one camp of direct equity to mutual fund with this experience of the volatility if this was your first
The
time.
diversification helps you there, right? So if a stock is falling 15%, maybe in your portfolio it wouldn't if you have other stocks as well. What exactly in that case is systematic withdrawal plan, Feroze? We always talk about SIP, but how can an investor go about SWP?
Yes. Sonal, with your mutual fund understanding, I think you are an expert yourself
No, not at all.
to give your viewers. But yeah, I'll try and attempt in an uncomplicated fashion. See, there is a need of money to be utilized. People who are individual investors, they have a need, is why they save. They have goals. When goals are getting closer, and if they are recurring goals, like you want to create a retirement plan for your parents, then systematic withdrawal plan is nothing but a instruction to an asset management company, a standing instruction to an asset management company to credit on a specific date of a month a amount from your mutual fund account. That's called a systematic withdrawal plan. The great part about a systematic withdrawal plan is its consistency and predictability. Second, its discipline, that you're selling not too much, not too little on a specific day. You're selling it in a staggered fashion. The third and the most important advantage is it's going to be tax efficient. Whenever you get a dividend, for example, from a stock, the entire amount which gets credited to your bank account is taxable. In a stock, if you got a dividend of 100 rupees, the entire 100 rupees has to be offered for tax this year, right?
Okay.
If you got 100 rupees from a systematic withdrawal plan, there is also a capital component and there is a return component. The capital component, there's no tax for that bank account credit which you got. Let's assume you got 100 rupees in systematic withdrawal plan. 20 rupees is your gain, 80 rupees is your capital. The tax to be paid is on the 20 and not the full 100.
Okay.
Just like an EMI, you pay a banker where you are giving interest and your capital repayment. Similarly, systematic withdrawal plan is an opposite of an EMI, which you end up paying to a bank.
Okay, all right. That's a very helpful explanation as well. Always a pleasure speaking with you, Feroze. Thank you so much for joining us today on this interesting discussion.